Hello and welcome to DigFin VOX, Voices in Digital Finance. I'm your host, Jame DiBiasio. If you enjoy the program, give us a like, subscribe, show us some love. My guest today is Mark Munoz, Managing Partner at Vectr Fintech Partners. Mark is a longtime venture capitalist, and he spoke with me about trends in VC, investing in fintech, and what's next in a tumultuous world. Mark Munoz, it's a pleasure to have you on DigFin VOX.
Thank you for having me. Looking forward to the conversation ahead.
We're going to talk today about venture capital at a very interesting time for the industry. And of course, you specialize in fintech, so we'll get into that as well. But let's just get straight into the heart of what's going on. How much of what we're seeing today with rising interest rates, the closing off of equity markets for exits, and valuations being completely reconsidered, how much of this should we think of as like akin to the dot-com boom and bust of 2001, and how much of this is really a separate, unique set of trends?
Yeah, it's a great way to start. Dive right into the doom and gloom of the world. Yeah, I do have.
Just had to wait a few years.
We do. The thing is, and fortunately and unfortunately for me and a few other folks out there, we have been through these cycles. I did go through the dot-com boom and bust. I was there. It actually started my first company that did just amazingly well. And we were able to exit right before it all fell apart. And having gone through 2009 and what we went through in 2010 as well. So there is some similarity to what we're seeing today, and we'll talk a little bit about that. But there's something that I thought was important that I was at a conference recently in Riyadh, and one of the gentlemen said, despite these hard economic times and what we foresee ahead, it's always brought out new innovation. It's always brought out new opportunity, and for the VC community in particular, I think it's not a bad thing that valuations got readjusted. It's not a bad thing that some startups are getting weeded out, which is tough to say, because you want to support all founders, but it definitely levels the playing field in a unique way that provides better opportunity for perhaps the VCs. And it forces these startup companies to take a long, hard look at how they're growing, and focus on some fundamentals. Now, with that being said, I'm afraid to say, we're talking ourselves into a recession. It's not a great thing. Inflation obviously is here. The interest rates are obviously high, and I don't think we've seen the worst of it. That's the real hard part.
Right.
And the same was true in the dot-com days when things were really falling apart and valuations were being slashed, and public companies that went public are now filing for bankruptcy. It was tough, but the market eventually, it was good for the market. It was good for investors long term, and we were better off for it at the end of the day, although it was tough for those few years.
I think the big macro difference, though, is that, in 2001, we didn't know it, but we were only halfway through the Great Moderation, this period of basically, falling interest rates from the beginning of the 1980s, and essentially benign conditions. Globalization was at that point really just beginning to take off in a serious way. Now we've got conditions where interest rates look to be continuing to go up, and they may moderate, but they're certainly not going to go away. We're not going to go back to the kind of ultra low, easy money rates that people sort of got a little bit addicted to over the past decade. And at the same time, we've got geopolitical tensions, the war in Ukraine, Beijing and Washington, glaring at each other. So we do have a very different set of conditions than we did have in 2001. So when you look at the portfolio within, let's say, your remit, which is fintech, do these big macro things, do they come into play? Do you have to think about that, or can you ignore that because you're just so focused on finding good companies?
There is an element of, we have to be aware of what's happening in the market. It affects our current portfolio, both in our first fund and even in our second fund, which we just launched earlier this year. 9 companies in our second fund over the last 8 months, and sure enough, there are some fallouts, not necessarily from the portfolio companies, but their prospects. So they were maybe working with some clients in Europe, which that's now been put on hold. They might have been doing financing in Southeast Asia, and that's really slowed down significantly. And so these macro events are causing a lot of ripple effects, even down to the smallest of small companies. And luckily, in some ways, luckily in some ways for our fund, we're very fortunate in that we had already raised Fund 2 by February of this year. I feel it's really, really challenging, and I know a lot of my friends, colleagues, other GPs at other funds are struggling to raise their fund now, to support their portfolios, to support startups around the region. So that's the really challenge I think that we have.
Yeah, and that is sort of a roll of the dice, isn't it? I mean, you got your LP locked in right before things began to kind of go south. So if you needed to get your LPs signed, in August or something, it might have been a different story.
Yes, for sure. And not only that, even our LPs are telling us, they're saying, look, what are your capital calls for the next 12 months?
Right.
We're going to prepare now. We want to make sure that that's locked in. Obviously, nobody wants to default, and we're not expecting that. I don't foresee that happening with other funds. But it's also a very fun call to get from your LP saying, "Can we deploy now? Can you do a capital call before the end of the year?"
Otherwise,
Good problem to have, I suppose. Yeah.
The other good problem to have is that now that you got a fresh round of funding to go after opportunities, the valuations that you're looking at with the companies must be a lot more attractive to you.
Yes and no. I mean, we typically invest at the seed and Series A stage. We do some deals now and then. In Southeast Asia, in Asia and broadly, maybe broad strokes for Asia, we haven't seen dips in valuations more than 5% at the seed level. So it's been very minute. At the A level, 5 to 10%. So there is a drop in valuations, but it's not significant enough in a way that we see bigger buying opportunities. It's in the U.S., although our investments in the U.S., we do see a little bit larger drop, and they especially are harder hit at the Series B and C levels. And so therein lies the problem, where our portfolio companies that have progressed from seed into the B round, they need to have enough cash for 15, 18 months, because they're not going to be able to get the type of valuations that we were even hoping for, let alone how they were thinking about it. And fortunately, we've got a good batch in there. The investments that we're looking at now at the seed level, we don't have to. We've never needed to really drive down prices at that level a little bit here and there. We are able to get interesting terms, additional pro rata rights or options, and sort of different types of longer term protection that we're given the amount of money that we're putting at risk.
So you operate obviously at that early stage level, which, as you just described, is fairly unchanged, because you're dealing with, at the end of the day, you're dealing with usually so many unknowns. It might be an unknown founder, unknown technology, maybe a brand new market segment. But then, at least in the past, let's say 10 years of VC, or 10, 15 years, the way is that you would then sell that on. You would either exit or hold on to part of it as it up rounds, increasing valuation. And then at some point, like a Tiger Global or a SoftBank or somebody like that would swoop in, and then it's a unicorn, and then you go list on NASDAQ and everybody's happy. But that doesn't happen so much now. And these stories are being, a lot of those stories were driven on questionable metrics, as opposed to solid foundational stuff. So in your area, down at the, that seed to stage A level, does that change the way you think about how to position and package these companies? Are these companies being packaged for the next milestone to get into a bigger round, and then create a story with total addressable market TAM type stuff? Or is it more sort of old school, roll up the sleeves, you're in there with your team, you're helping these guys maybe not operate the business directly, but you're much more involved with helping those companies? What do you see happening there in terms of that role for you?
Yeah, it's a mixed bag. Just to put it out there. I'm not going to try to dodge the question because it's a really good one. It's one we think about every day. Um, but look, I feel like we've always had a philosophy that's very different from um, the Tigers and the Hill Houses of the world, or even the A16Zs and Sequoias, and that our portfolio, and given the sector that we're in, we we never needed to grow a company for growth's sake, for that grow at all costs type mentality. That was really never our mantra, particularly in fintech, because and particularly in fintech B2B, because we're dealing with young technology companies that are delivering very compliant, secure solutions to larger financial institutions. So you want to make sure that the business fundamentals are right from the beginning. You want to make sure that the company is going to be solvent through and through as they're delivering for some of these big corporate clients. And so we've always focused on just the basics, the fundamentals. What does CAC, what does the LTV look like? And of course, at the early stage, we can't tell. I wish I could, but we can't. We can only roll up our sleeves, you sit there right next to the founder and try to study the same problems that they're seeing, whether it be in distribution or a client contract or hiring development team, versus the, hey, here's your 2-3 million, and let's see where you end up in terms of user base and API calls or what have you. That's really not how we can operate. And I think you've seen that change, going from sort of funds and VCs who may operate at 300, 400, $500 million funds for many years, changing back towards more of what problem are we solving? What are the fundamentals to get this company from C to A, and how does it become profitable? And I'm, really, really excited that one of our Singapore companies recently, just this year, became profitable precisely because we could focus on a lot of these fundamentals.
Let's talk about the fintech scene in general. You always, investors such as yourself, you're scouring all these different stories. Are there particular segments that you focus on as, I guess, baked into the Vectr mandate, or are there just stories or themes that you are gravitating towards, whether intentionally or it just happens to be where you find the good founders right now?
Yeah, I think it's quite funny because as we look at the fintech companies in the public market and seeing how just devastating their price has dropped, it does make us rethink the world. It really makes us rethink the sectors and the businesses and sort of not just the fundamentals that they had, but how they were going to market, what was their current budget for perhaps user acquisition and those things, and try to then sort of readjust our thought process as what we're seeing here, maybe in Hong Kong versus Singapore versus the Philippines, and go, are we seeing similar businesses in the public market today that have just been crushed? And all tech across the board has been crushed, so it's not just fintech. So broad strokes there, but are there lessons learned in the public markets that will help us, identify companies that in Asia that might be winners? With that being said, that has changed our perspective. But we go back to the basics. We look at the founder, we look at the founding team, we look at the problem they're trying to solve. We honestly, in Asia in particular, we don't focus so much on TAM or SAM. We focus on long-term partners or strategic opportunities where we see this company being able to grow at a rate that will provide them sustainability and help them move through that chain. Now, with that being said, you can look at every country and have a different view. Hong Kong, of course, we're looking at companies who have very good GBA opportunities, very north of Hong Kong opportunities, how they're going to market there, what does that regulatory structure look like? Philippines, we see some fantastic companies with just some amazing founders. And so that's a big focus area for us. Singapore is also very strong in a number of areas in terms of wealth management products, and so we're looking at wealth management solutions for Southeast Asia, and actually exploring Vietnam. There's been a number of innovations there and companies that are coming to market that we think are right, and it's traditionally in the infrastructure side of things versus deep tech or capital markets.
do you tend to think of these companies in sort of these geographical buckets because that's how you do business in Asia? Or do you also have an overlay in terms of, oh, okay, I'm thinking about artificial intelligence, or I'm thinking about blockchain, or data or cloud or whatever?
Yeah, I mean, Southeast Asia is just Asia in general. We do look at it country by country. We look at it country specific. We have broad themes of what we're trying to invest in. Um, cybersecurity is one area where we're very excited about what we're seeing out of the U.S., out of Europe. We don't see as much here locally, but there are some really good companies in that space. Um, we do think that there is opportunities in digital private banking, sort of high end or high net worth products and distribution. There's a very interesting company in the region that's doing some unique things there, but we see most of those opportunities, again, broadly speaking, in the U.S. And so for us, it's always a very country specific type of endeavor. And what we found, just lay it out there, is you, if you look at the trends and the themes that we see in North America or Europe, we see a lot of Me Too companies in Asia. If
Okay.
we think about deep tech, we're seeing much more North America, Asia, North America, Europe, Israel. We see less deep tech sort of opportunities here. But when we look at specific asset classes, specific distributions, payment networks, infrastructure, we see a lot more opportunity in individual countries around Asia.
Because they're originating things that suit emerging markets perhaps better than what they might come up with in the West. Is that broadly right?
Yeah, that's right. I mean, take a look at our investment in Microconnect, which is a fantastic revenue-based sharing technology distribution company that's based here in Hong Kong, that's focused on mainland China. They've been able to land clients in every province in China, bar one. They just haven't been able to find a good opportunity there yet, but they've been able to distribute their product very rapidly into a market which is right for these types of this type of lending. Well, not even lending, it's revenue-based sharing.
That leads to one question: is scale. So if a company does well in the Philippines or in Hong Kong slash China, uh, or Vietnam, how easy is it for them to grow then regionally or beyond? Are these companies being groomed to be kind of global companies from an early stage, or are they really becoming, local companies that may someday have something that they could take beyond?
Yeah, that has been a big challenge, I think, for the VC community as a whole. And our approach has been one where we want a company to just focus on its core market, own 30, 40, 50%, if not more, of their core market, become the champion in their core market, and then look to jump off. And then when you do jump off, right? When you do jump off, in many cases, not always, but from what we've learned over the decade plus doing this, is it's often better to do a JV with a local partner there, right? And so we've seen great sort of investment opportunities in great companies. For example, in Japan, they try to move to Southeast Asia, and they struggle. But those who have done a JV, perhaps with an Indonesian fintech or a Singaporean bank or whatever it may be, end up being really winners. And you find at that point that we can open up the probabilities for a higher exit, right? Because that is ultimately, that is the name of the game for us here at Vectr, is we do want to foster a good founder community, but we want those founders and the fund to really find exit opportunities. And so our strategy, and this applies to Asia, this really applies to Asia, is that those companies where we're able to find that they've grown from seed to A to B or whatever it may be, there'll be an opportunity perhaps for us as a fund to sell down 10, 15, 20% of our position in that company in a secondary or in the next round, return money back to our LPs, make the fund whole and then some, and yet continue to be able to support that company in the right way. And I think those companies that are able to start off in their country, really prove out their solution, not just find product market fit, but basically find dominance in their category, are the ones that will really have the best opportunity to jump off into other countries and ultimately be good fund returners for us.
I'd like to ask you, as we're getting to the end of this, Mark, some areas that have been controversial this year. Obviously, the crypto markets are being roiled by all kinds of problems. We don't need to go into that. I think everybody knows what those are. But you have a few blockchain companies in your portfolio. Maybe differentiate between enterprise blockchain and retail style crypto stuff. But just how do you see when you see this kind of turmoil going in that's associated with a particular technology? Does that color your view of how to position fintech B2B enterprise companies that are using this technology?
Yeah, we're still very, very bullish on digital assets, despite what's happening with FTX and what's happened in the past and the amount of things that have gone wrong in that space. And therein lies our thesis, and therein lies the homework that we do, which is to do exactly what you described, Jim, which is we divide the world into there's blockchain technology, there are the tools, the services, the security layers, the things that enable blockchains to function and function well. There's the crypto asset, and the product that get distributed, be it institutional. We are not in that. We don't invest in that space out of the fintech fund. We don't invest in tokens specifically. We always look for equity. We find that's the best way we can support founders. And then you have the things that are in between. And those things in between, we also invest in. That could be custody solutions, where we invested in Credo, could be institutional network, so Paradigm out of Singapore. We've just invested in a company out of Europe called Master Exchange that's doing something quite unique in the digital rights space for music. But again, these are building blocks. These are the tools that you need in order to distribute products and services on the blockchain to a wider mass, and that's key to us. And so that has actually been how we manage our risk. We're not and that's not for lack of want, but it's what our LPs and where we see the best opportunities. Because again, when we look back, and this is super important in terms of how I think folks should look at the space. When the internet was really taking off in the .com area, go back to what happened there. Yep. There was some amazing companies that were building networking equipment, like Juniper. They were building routers and hubs. Those are great infrastructure plays and great investments to be making. And that's how we look at the blockchain space. We want to invest in the tools and services that are doing the distribution and protection and underpinning for the technology.
Do you have a view on AI? I forget how long ago it is, but Andreessen, of course, talked about software eating the world. Now we're looking at AI eating software, which I think is an NVIDIA quote. And then in fintech, of course, I read about this and I talk to people that use AI, but it's always a little bit on the dull side. It's helping some asset manager, do their compliance reporting a little bit better or something. It doesn't get the pulse racing. But it's obviously super important to these institutions and able to manage fraud risk and be more efficient. But this year we've seen incredible stuff, not in fintech, but just the generative AI with illustrations, text, poetry, even coming out of some startups in the U.S. And it's pretty mind blowing, right? I mean, it's very cool stuff. You've seen like the DALL-E illustration work and stuff like that. It really brings home the power of this stuff. So I just wanted to bring it back to, do you have a view on, in your portfolio and the companies you work with that are working with artificial intelligence, are they, do you see that accelerating or becoming more relevant to financial institutions in some way?
We do. We have invested in AI companies, fintech AI companies specifically. And I think to your point, I actually quite agree with the sort of the development and the progress of AI in financial services. We haven't seen anything that's as mind blowing as the Dolly. So that was pretty amazing. But what we are finding is that first generation, and actually it's more like second generation of AI that's out there in the market today, are able to sort of provide real this might have to back up on this, but ROI. This generation of AI companies that we're seeing, and even the first ones that we've invested in, are now at a level where they're able to show an ROI for their clients in a material way. And it's not just robo advisors; it's being able to digest information faster and get more accurate results when you ask it a question. We invested in a no-code, low-code AI platform for financial institutions, and it's probably one of the largest wealth management AI tools for these groups that digest 10Ks and SEC reports, and then are able to return back answers to questions the analyst might have. And it's doing it in a very significant way, where it's not just saving time, it's providing new insight that the analyst may not have thought of before. I still think we have a long way to go for fintech in AI. You see a lot of companies that just throw AI into their technology stack to say that they have it, without really focusing on the deeper tech and benefits that it can bring. And so I think we're going to see more and more and better tools over the next couple of years. And it's a space that we are obviously looking to invest in.
One last question for you, Mark, and thanks so much for your time today. If I'm a founder and I wanted to put together a pitch deck for Vectr, I'm doing fintech and I'm looking for funding. The elements of what's a successful pitch to you today, is that different than what it would have been, say, 2 years ago, or is that unchanged?
It's really unchanged. I mean, I think a lot of the fundamentals for where we like to invest is the origin story, the founder's background. Why are they doing this? They don't have to be a domain expert in whatever they're trying to do. We've learned that quite well, but it's really what problem you're trying to solve and how you're going to go about it. It's the basics.
Yeah, great. Well, good luck with the rest of the year. Hope those capital calls come good for you, and of course for your founders as well. So it's been a pleasure speaking with you, and thanks for your time, Mark.
Thank you, Jim. Have a great day.